Hello and welcome to Bunnex Investment Group. Today we are going to talk about the M and W setups in the market maker method context. These are the most accurate setups in the market maker subject. But before we jump into the whole video, be sure to check out our free signals Telegram channel. The link is in the description below. Before we go further, I would like to give you an awareness to be careful of people who comes with phone numbers in the comments section. Some comes with testimonials and emails. To get in touch with me, join this free Telegram channel. That is where I share my contact details. So here are important notes to take away. M's or W's occurs at the peaks of the market. A peak is the last point of reversal after the cycle is completed. Peaks occurs at the high or low of the week and at the low or high of the day. Before we go deep with these patterns, we will need to first clarify their points of occurrence. The first point of occurrence is after every 3 levels of rise or 3 levels of drop, a point of reversal is issued. As mentioned earlier, that is the point where M's or W's occurs. 3 levels occur in every cycle, that is intraday, weekly, or even monthly. To understand this concept further, visit one of our videos that I shared earlier on this channel. But basically, this is what I mean. This is a reversal point. As you can see, if this is a weekly cycle, it means this one is a day 1, day 2, day 3. Within these days, we have 3 pushes to the low, 3 pushes to the low. These are the points where we refer to as the points of occurrence of the M's and W's. So points where M's and W's occurs in the market. This is a market maker cycle, the template of the market maker cycle. It definitely does not appear as clear as this one, as if it does so, everyone would be a millionaire. But at the initiation peak, we expect a W, which will be a multi-session W, and at the completion of the cycle, we expect an M. Within the cycle, we also expect a W, that is if we are in a bullish cycle. Then if we are in a bearish cycle, we expect an M, initiation of the cycle with an M, then an M within the cycle, and end the cycle with a W. This one and this one will be also multi-session W's. So the essence of this video is to teach you how to trade these W's and these M's. So here's the anatomy of the M and W. We have 3 types of M's and W's, and these are the normal M or W, the extended M or W, and the trap M or W. Here's the normal M or W. The length of the legs will be equal, that is the first leg will be equal to the second leg. And on the W, the same concept applies. We have the same length of the first one to the second one. Then here is the extended M and W, where we have the first leg shorter than the second leg. In this scenario, market makers are trying to hook out all the stop losses that are within the region of those who have entered on the first leg. They will be just trying to take out all those stop losses. Then we have the trap M and W. In this scenario, the market makers can no longer afford to push the price to the region of the first one, because if they do so, they will release traders that have gone long in this scenario at this point, and going back to this point will release these traders. So they will need to run away from these traders and trap them for the next part of the cycle. Same applies on the W, trap W. The market makers can no longer afford to come back to this point so as to trap traders who have gone short at this point. So let's look at how they occur on the charts. This is euro against dollar. As I said earlier on, that we have to anticipate their occurrence before they come. And that is always done by 1, checking for levels, that is after 3 levels of rise or 3 levels of drop. 2, that is at daily support or daily resistance or daily supply and demand zones. So at the daily supply and demand zones, that is where you anticipate occurrence of M's or W's, or after 3 levels of rise or 3 levels of drop. As said in the earlier videos, a level on the H1 time frame is equivalent to a day of rise or a day of drop. As you can see, we had a trap W here where market makers could not come back to this point because they were afraid to release traders who had gone short, so they ran away. So we were issued the first type, another type of our W. Then we had level 1, consolidation marked by this purple box. Then level 2, then pullback marked by this purple box. And then level 3 up to another setup. At this setup, we were issued the normal M, which is 2 legs at equivalent zone. The first one is equivalent to the second one, and the market moved away. Basically that. So how to trade them? Firstly, you need to have a reason for expecting occurrence of an M or W. So here are the few reasons for that. The first one being the daily time frame, daily or demand zone. Then the second one being cycle completion or 3 levels of rise or drop. So on the first one, let's take for instance, we have our daily cycle. In the earlier videos, we discussed that we expect that after a break of a zone of resistance or a zone of supply, we expect the market to retest that zone. And mind you, this will be viewed on the daily time frame. So if the price come back in this zone, and this is the zone that I am implying for you to expect occurrence of a W in this scenario, so that the market will take off going up. This is the first reason to anticipate occurrence of a W. Then on the second one, on the second reason, we have had 1, 2, 3. At the third level, we now expect occurrence of a W in this scenario, and we take off. So as I said, that you need to have a reason for expecting occurrence of the M or W before it actually happens. So first, you need to see a nameable first leg within that zone of anticipation. On the anticipated leg, second leg, you need any confirmed candlestick reversal pattern on the H1 time frame. I'm sure you are all aware of the candlestick reversal patterns, and we've discussed some on this channel. That is either a hammer or a bullish engulfing pattern like this, or a railroad track whereby you see a green candle, a red candle, that will be equivalent to a green candle. This will be a railroad track. This is a bullish engulfing pattern, a hammer. So you need to see any confirmed candlestick reversal pattern on the H1 time frame, that is on the anticipated second leg. Then you enter after H1 candle closure. So as I say always, without discipline you will never be consistent, and without consistency you will never achieve the goal. So do a lot of meditation and stick to the only trades that we have discussed. And always remember that not to give yourself pressure. In conclusion, follow your plan without deviation, distracting thoughts, or hesitation to act. On that note, thank you for watching. Like and subscribe, and check out our free Signals Telegram channel. This is the link in red.